is Thursday, March 11th, 2021. This is the fourth show for this week and the final one. Don't worry, we'll be back Monday at noon. Today, I'm joined by, we have a full house today. I'm joined by Carlos Ponce in Cuernavaca, Mexico. Hi, Carlos. And I'm joined by Kim Lantis in Hermosillo, Mexico.
Hey.
And Mariel Navarro from Chihuahua, Mexico. Hi, Mariel. Hi, Kim. Hey,
Hi.
Carlos. All right. So everybody's wondering why you got the full house today? Because we got an awesome topic and an awesome guest that we're going to dive into in just a minute. Before we do that, let's get to know our guest. His name is Miguel Fernandez. He's the CEO and co-founder of Capchase. And we're talking about money. We're talking about corporate financing, money that you need to grow your business. Everybody's favorite topic, right? So before we get into the topic today, let's get to know Miguel a little bit. Miguel, could you please introduce yourself? Tell us a little bit about yourself.
Hey, today, yeah. Hi, team. Good to be here. Yeah, so I'm Miguel, co-founder and CEO of Capchase. Let's say a bit about myself. I'm originally from Madrid, from Spain. I grew up there, lived in England and Germany. Then I'm an engineer by studies, by background. Sorry, I did mechanical engineering in Madrid. I did energy engineering, nuclear in Munich, and then I started my career in consulting. I did a couple of years in consulting, doing banking, TMT, and retail. Fell in love with fintech there and with tech more broadly. Then I left consulting, joined a pre-revenue SaaS company in Madrid, where I was the first person in sales, and I built the sales and customer success teams there. And then I moved to the UK to open up the local office, to London again to open up the local office, build a team, enter the market, and so on. So during those 3 years, as we took the company from zero to a few million in ARR, we experienced most of the pains that we're trying to solve right now at Capchase, which we can jump into that a bit later. And then after those 3 years, I left to go and get my MBA at HBS. I spent the first few months researching a lot around working capital and how to help companies to either pay later or get paid earlier. And then we looked at different verticals, and that topic that we were learning so much about clicked together with the pain that we felt at our previous company. And then we came up with the idea of Capchase. We dropped out of business school and have been working at it since.
Wow. Okay, let's talk about Capchase. What is it? What do you guys do?
Yeah, so let me start by what we aim to do in the long term, which is basically put funding on autopilot so that tech founders can focus more on what really matters, right? Which is creating amazing products and distributing those products to customers. So how we're doing this is we understand really, really well all the future payments that are going to be coming into a company, into a tech company. We do so by connecting to the systems, understanding, okay, from now to 12 months from now, what payments are going to come in whatever shape or form. They can be subscriptions, they can be annual payments, renewals, they can be transactional, payments from customers and so on. And then we give access to up to 60% of those to the company on day zero. So they can reinvest those future revenues into growth instead of tapping into VC money or getting banking debt, which comes with a lot of bells and whistles and comments and so on. So yeah, basically what it means is that founders can raise the money to run their businesses in a second instead of a bunch of meetings and so on. And then they do so without getting diluted, which is great for them. Because, I mean, I'm not sure if you know this, but you probably do. The average funding team only owns 15% of the equity at exit, right? So with Capchase, they get to own all of it.
Yeah, it's quite a shame sometimes that when you do the math, you would have made more just being an employee somewhere. But we can talk about that another time. This sounds like an interesting topic. I mean, what I heard is the easiest way to get money for your business. So let's go right into the topic. Who's introducing the topic today? Kim, are you Carlos? Yes, please. Let's kick it off and get right in there.
Absolutely. Well, first of all, thanks, Miguel, for joining us today. And Tulio, today we're going to be answering one question. The question is it possible to achieve hypergrowth without selling large parts of your company to investors? And in other words, we're going to be discussing the topic of financing beyond venture capitalists. Dilution is not the solution. So, Miguel, let's start with that. Please tell us and the audience, why did you choose this particular topic and why did you think it was relevant for this day and age? Thank you.
Yeah, sure. Why did we choose it? I mean, we're speaking with hundreds of founders every month, of tech founders specifically, right? And the most obvious pain in a growing company is getting financing to grow the business, right? So there are a few ways to get financing. There's the traditional, well, let's say there is the bootstrapped way where you don't get any external financing, and you have to be very conscious about how much cash you spend in the business. You have to understand when cash is coming in. It's really hard and it's kind of slow, right? So then sometimes, in these tech companies, when you need a lot of upfront investment until you can generate revenues, there's the other route, which is selling parts of your business to venture capital to get cash to then grow the business quickly when you don't have revenues yet. So that process takes a lot of time and is very expensive. The average founder takes 30 meetings to get a term sheet. And then when they get a term sheet, they sell a part of the company to get money. And they do so, let's say, 4 or 5 times over the life of a company. So then at exit, they end up owning a tiny bit because they've been selling parts and parts and parts and parts to fund the growth. So it was a pain that we felt in the past. We didn't know how to deal with it. And now with Capchase, what we're giving these founders is the moment they get revenue, they can start tapping into those future revenues to fund growth now. And then these companies are growing very fast. The future revenues, they start to get larger and larger and larger, which can generate more and more growth. So it turns into a flywheel of growth that really changes the way they operate the businesses. They can grow much faster without the operational hassle of raising money, and then they can keep more parts of the business.
I see. Thank you. Thank you so much. That was enlightening. Okay, guys, Tulio, Kim?
Yeah, so I'm curious to learn a little bit more how it works, right? I know of factoring where you borrow against your contract values or your invoices. Usually you can strike a pretty good deal on low percentage rates with many companies who do that. Have to prove the value of those contracts. Good reason why you want long-term agreements versus short-term agreement to have higher value for that purpose. I know of debt financing, which obviously takes a long time. The factoring is the one I've historically seen as the fastest route to money. What's different about this? Is it similar? What's unique about this? And how do you go about validating future value?
Okay. But yeah, I'm just tapping the questions to make sure I remember everything. Yeah, so factoring, right? What's the difference? Factoring is associated to an invoice, right? So you need to send an invoice, and then the factoring, what it does is that the factoring company buys the invoice and then owns the invoice and is the one in charge of collecting from the final customer, right? So what this means is that suddenly incentives get missed. The tech company wants to give a very good service to the customer, right? And the factoring company only wants to get paid. So the factoring company doesn't care about the long-term relationship. They just want to get paid. So they keep exerting pressure into the final customer to get paid. So what would be an opportunity to create a relationship doesn't happen, because instead of the tech company having a relationship with the customer, it's somebody else asking to get paid. So then also, if you have customers that are paying monthly, you have to issue invoices every month, and you have to send them to a company to go and factor them every month. What Capchase does is it connects in real time with the data of the company. It understands exactly what payments are going to be coming in, and then we just advance those payments. We're not buying those payments. We're not buying the invoices. We're advancing against them. So then the whole operation is exactly the same. The end customers keep paying the tech company, but when the money comes in, automatically Capchase spots it and gets paid back. So it's invisible for the final customer. Operationally, it's seamless. You don't need to sell invoices to anybody or assign rights to anybody. It just all happens in the background without anything. And how it's different from debt, right? Debt usually is senior. It's senior to equity, right? So if the company, for a reason, goes under, if the tech company goes under, until the debt holders get paid, nobody sees a dollar, right? And if they salvage the IP and the assets, nobody sees a dollar after before the gets paid off. Capchase is not like that. It's super light. It's not dead. It has no claims to any assets or anything. So then it is just a very light structure to set up, no reporting, nothing. Everything happens in the background. Just some advantages against that.
That's really cool. I have a question related to that. So you basically serve companies that pretty much work like giving software as a service. It's something like, let's say, subscriptions. Do you guys work with any other companies, or that's your market, companies that offer subscriptions?
We offer with any kind of tech-enabled recurring revenue companies. That can be, companies that charge everything yearly upfront, or companies that have a combination between subscriptions, contractual revenue, transactional revenue from a ton of different transactions from the same customer bases. What we're looking for is companies that have tech-enabled processes and that have a customer base that keeps paying with some frequency. It can be every month, every day, every week, every year, but we can actually forecast what will happen in the future, looking at the current customer base.
Speaking particularly in the case of a subscription, what happens if a company offers subscriptions, they start working with Capchase, and then for some reason customer canceled the subscription, but they already got the money up front from you? What is the scenario there?
That happens all the time, and it's nothing happens, right? It's what happens is that the system recognizes that a customer has stopped paying. So first of all, it tells the tech company like, hey, like customer 3 stopped paying. And then what it does is it looks for all the other customers that haven't been financed against and looks at the most similar one to, let's say, customer 3 that churned, and then substitutes it. So then there's another customer making up for those payments. And for the SaaS code, this means that they don't have to pay. For the tech code, means that they don't have to pay back anything. They just get a report like, hey, customer 3 stopped paying, and now customer 11 is making up for it. So that's the only thing.
That's cool. It's a team effort.
So it's basically financing on an as-needed basis with what's available basis. Because I'll be the devil's advocate here. I'm kind of good at this. You know the adage, when something sounds too good to be true, it's probably not true. So who's assuming the risk here? What is the risk?
The risk would be that, imagine that instead of one customer churn, imagine that 50% of the customers churn, or the company runs out of cash, right? The company runs out of cash, then we take the risk, right? Capchase is taking company risk, and it's like if the company, if that happens, like we lose, it's fine. We try to help everybody to not get to that position, but sometimes it hasn't happened yet, right? Ever, but it will happen for sure, right? So but then like the churn risk, that's a different risk, and that's taken by the company itself, right? If a customer churns, then we just substitute one customer. Yeah, I mean, and let's say it's too good to be true. I guess that it's just that this technology wasn't available a few years ago, right? And now it is. So then, like this would be considered standard a couple of years from now, right? It would be just like the way to fund tech business, and it would be business as usual. It won't be too good to be true. But it just simply didn't exist last year, right?
Very cool. So what are some of the safeguards that are taken in place? Like when you're looking at who Capchase is going to partner with, what's that ideal, partnership? Who's that profile? And what are you doing to protect yourselves in addition to your users, of course? Yeah,
so it's really tech-enabled predictable revenue companies that are growing more than 20% year over year. And that's pretty much it. They have recurring revenue, right? So then what happens is that what the system does is it understands really well those future payments. It understands when cash inflows are happening and when cash outflows are happening. And then it tells the businesses, hey, you could get up to, let's say, 60% of your annual recurring revenue today. Let's say, let's put numbers. Let's say a $10 million annual recurring revenue company, they could get up to 6 million from Capchase, right? And then as they grow from 10 to 30, they could get up to, when they are 30, they could get up to 18 million from Capchase. But if you think about it, nobody needs that much money up front unless they're going to buy a competitor or enter a new market or whatever. So then what the system does is it recognizes all these cash inflows and outflows and spots when there are going to be cash gaps, right? And says, hey, you could take up to 6 million if you want to, but this month you should take 300K. The following month, 1.5 million. The third month, you have a few renewals coming in, so take 0 because you don't need it. The following month, take another number. So the system prescribes how much they should be getting, so that every time they get money, they can deploy it automatically on return generating activities like customer acquisition or covering working capital, and so on, as opposed to having a ton of cash in the balance sheet that's just costing money and it's not providing returns.
Okay.
I got a question here. Yeah, Miguel. From the average user standpoint, let's say that I am a software as a service company, and I'm starting into looking into Capchase as a possible alternative. So, as you know, we've been last year and even this year, we're all going through a lot, and technology is no exception, right? So we're all like, a lot of things are happening. So, and because we're discussing money, we're discussing funds, we're discussing transactions. What would you say to someone that might have, concerns about, let's say, security or cybersecurity? What is Capchase doing in this regard, just to prevent, bad surprises, if applicable, of course?
Of course, yeah. So we have like bank-grade security, and for example, we don't manage any personal information at all from officers or from customers or from the companies that our customers are working with. All of that data is encrypted. So, I mean, if somebody were to break into our systems, which would be pretty hard, it would be as breaking into a bank, right? They would only get strings of numbers and letters that mean nothing, right? And like, there's also no access to the flow of funds. So in that case, we take this extremely seriously. There's no room for error, when it comes to how much money the customers are getting, how much money we're getting back from them, and so on. So yeah, we take that extremely seriously. We dedicate the best and brightest minds to that.
Perfect. Okay, perfect. Yeah. Guys, go ahead, please.
Let's shift a little bit about the journey of building this company. Is this something that's new, that's disruptive, or that's been done before? How do you go about? Have you gotten any pushback? What has it been like to get adoption? It seems so simple and straightforward, but what's it been like to position this, to sell this, to gain customers?
It's been absolutely crazy, right? Like, we went live and then things exploded, and we've been growing incredibly quickly every month. So month after month after month after month, we have achieved, like what the average company takes 4 or 5 years, we took 6 months. It's insane. It just keeps growing like crazy because the founders, this really changes the way that these founders grow their businesses. They go from growing, let's say, 4 or 5% month over month to growing 10, 15% month over month without selling parts of the business. And they keep unlocking more and more future revenues to grow. And then if you keep unlocking more revenues to grow, then your future revenues become larger as well because you're going to invest more into acquisition and so on, right? So it's like turning companies into growth flywheels. It's amazing for them. And then they keep telling their friends, and their friends start using it, and they keep telling their friends and so on. So yeah, the adoption has been phenomenal. We have been very surprised. We've grown the company from 4 people to 30 people in 6 months, and it just keeps growing like crazy. And yeah, it's working really well. And we just keep thinking, and asking these founders, like, hey, besides cash and financing is obviously a problem, but what other problems are you facing, when thinking about managing your revenue, managing your cash? Like, what comes next, right? Financing is one part, but what comes next? And it's great. Like, we're getting incredible feedback, and yeah, I don't think the world is ever going to go back to a world before Capchase, right? Like, just financing companies based on VC money. It will be a combination of.
So are you disrupting the Series A, that whole evolution of VC funding, or is it more like the next, a seed B round kind of a thing, pre-Series A kind of a thing? Where do you see yourself playing? What's the sweet spot that you're really going after?
I think that we are not disrupting VC so much. Like, VC funding, I mean, going down the VC route is not just about the money, right? It's about the partner you get. It's about the advice, the introductions, the team, and so on, right? So I guess that we will be disrupting, one, bad VCs, like VCs that just give you money and nothing else. That is the most expensive source of capital that you would ever get. And then all the traditional sources of financing, like debt and things like that, that seem to be like, they're like lambs in wolf's clothing, right? Like relatively low price, but then they start putting a bunch of opening fees, unused fees. It takes 8 weeks to renegotiate. They have a ton of covenants and warrants and guarantees and so on. Those things, like, they need to evolve or they will disappear. So those are the ones that we're disrupting more. And
Interesting.
in terms of the stage, sorry, I would say more towards the Series A, B, and C. That's where companies start working with Capchase, because before, like when they have no revenues, they need to get another source of financing, right? But when they start getting revenues, they start tapping into those revenues to fund their growth and their future revenues, and it becomes like that flywheel I spoke about earlier.
One of the things that I envision that comes next, and I understand this not to be your current business model, but would be the idea of like financial like consultation services, because from my own experience, once I have that money in hand, that money is a lot easier to spend. So what do you do, or how would you advise your users to spend that money that they now have that they didn't previously have wisely? Like how does one go about avoiding that temptation?
Yeah, exactly. So that's why we want to understand really well all the payments that are going to be coming in the future, so we can recommend what is the right amount they should be taking. Because the truth is that, like, founders are so focused on growing the business that sometimes the easy way is, I'm going to get as much money as I can, and then I figure it out. But that really, it can be expensive, it can be inefficient, and so on. So that's why the system recommends how much it should be taking on a monthly basis. And then there can be some optimization problems put there, like, hey, I want to cover all my acquisition spend and I want to have zero burn, right? So then the system recommends you, hey, this is how much you should be taking. Or I want to get to cash flow positive status in the following 12 months. Then the system recommends how much you should be taking and how you should be spending it to get there, right? So financial advisory, I think it's complex if it involves like a lot of people, but the system can more or less substitute at least how much the decisions around how much money you should be getting and when and where it should be deployed, right? So
So I guess it's the right solution depending on the maturity of the team and their ability to execute, right? So I think one of the values, as you mentioned, that VCs bring to the table, besides the connections and the recommendations they can make in advancing a company's objectives in the marketplace because of those connections, is also the ability to look at operationally where there's gaps or opportunities to make improvements, right? To get those things either cash flow positive, or be smart about how long the money that's being lent or given will last. So that's why they're involved. They get a seat on the board and so forth. So what I'm hearing is this system does some of those things if you're savvy enough and you've got the experience to make some of those decisions on your own, and you don't necessarily need that value add that a VC does. Did I hear that correctly? And if that's the case, how do you work that out? Do you have some algorithms you've built in? Are you using some AI? How do you get the feedback to make those intelligent recommendations?
Yeah. Okay. So let me divide that into a couple of answers. So the first one is that most of our customers have either some degree of VC investment as well, and they use Capchase in combination, right? Mm-hmm. And then as they get more mature, the Capchase part becomes larger and larger because their future revenues become larger and larger, right? So they are usually working with a VC as well, and they know. I mean, they have been operating their businesses for more than 12 months usually. So then they know where the money, how to deploy the money to get growth, right? And the system recommends them how they should be doing it and in what, how much they should be needing to get the targets. And how the system does it is basically based on algorithms and based on forecasts that are carried out by our underwriting algorithms, by our data scientists, and so on. So it's, yeah, a mix of.
I think that's really beautiful, and I think that there's like this hope, going back to the title of today's show, dilution not being the solution. So even if that first step is, some venture capital, and you've, let's say, lost X percentage of your ownership, as your company is successfully growing by capitalizing on Capchase, then you're essentially gaining back percentage, right? And you can kind of come, which would, I imagine, be much harder without utilizing someone like you.
Well, yeah, I mean, look, the biggest challenge companies have once they start rolling and they sort of crack the code on scaling is not being able to scale fast enough because of lack of capital, right? So that's where you start going for a Series A or a Series B, because you're trying to infuse the cash that you need to expand the business to keep up with the demand. And unfortunately, you end up giving up equity for that and you get diluted. And the other options for financing are not always necessarily very attractive. So what I'm hearing is this isn't the one or the other, it's an enhancement, right? You have the other option to say, hey, you've got contract, you've got user base, you have subscription, there's a trajectory of where they're going, there's money we can give you without diluting the business in such a way that you can keep up with the demand and continue to expand your business. If we hit the nail on the head on that?
Exactly.
Excellent.
Absolutely. Yeah.
All right. Let's shift a little bit.
Dilution is for chemistry, not for cash.
Exactly. Dilution. Let's talk about a little bit the company's culture, right? Because this is pretty cool what you guys are doing. What kind of people do you typically attract to come work with you? I mean, are they people who are trying to change the world? What's the typical kind of individual that would want to come work for you that you guys are creating a culture around?
Yeah, so it's mission-oriented people, right? Like that really want to change the way that founders, really want to change the state that founders maintain at exit, right? And we're looking for people that are super smart. So let me tell you about our values, right? The overarching philosophy is that it never gets easier, that we just go faster, right? Whenever we achieve a milestone, it's never like, oh, we did it. It's always like, hey, what comes next, right? How can we become 10 times better? How can we do things 10 times faster, right? So it's always about getting better and better. We're looking for people that are intellectually humble, so very smart, but also they know that there are a lot of things that they don't know yet and put things in place to learn and learn. For people that are builders, that going from 1 to n is hard, but going from 0 to 1, that's where the magic happens, right? That's where the true innovations happen, and we're looking for people that enjoy that. And then for people that work hard but work smart as well, right? Like, it's one thing to push really hard, but if you're pushing in the wrong direction or against the wall, you achieve nothing, right? So working smart is just as important.
Nice. Guys, you guys have any additional questions? Otherwise, we're up on time.
Not right now, Tulio. As a matter of fact, we only need the time to make all the proper announcements for next week.
I just have one final question, Miguel. This is your first startup, right? This is your first business as an entrepreneur. Any words of wisdom of what that journey's been like, things to avoid and things to really focus on for those who might be sitting on the fence thinking, I want to go down that path, but I'm not sure. What would you say?
I think that's something obvious, right? Like the most important thing is people. Right? As a founder, there are a lot of things that I don't know, and there are many people out there that are way better than me in a lot of ways. So it's about thinking who do you want to get excited about joining the team that can raise the bar for everyone and keep improving, everything in the company. So it's about spend time thinking about who you want to bring on board and do whatever it takes to get them excited to come here, raise the bar, and teach everybody how to do things better.
Well, it's been a pleasure to have you, Miguel, as our guest. We'll have to stay in touch with you to see how you progress along. Stay with us as we go off the air. But before we do, let's announce what's coming up next week. Besides the recap show on Monday, we're going to recap all 4 shows of this week in 10 minutes. Come join us at 12 o'clock noon on Monday, 12 o'clock Pacific. If you want to be one of the squares here, one of the Brady Bunch squares, just make a comment wherever you're watching us saying, I'd like to participate. And one of us will reach out to you, make sure you're part of that. What do we got coming up next week, Carlos?
Absolutely, Tulio. Thank you so much. Well, Tulio, next week we have a full week too. On Tuesday we have Livia Kasman from 28 Health, which is a telehealth company. And then on Wednesday we have John Stern at Rinkpin. Rinkpin is a QR, what's it called? QR code, QR code platform.
Mhm.
I hope I got that right. And for customer support. And then finally on Thursday, we're going to be speaking with Ariel Lopez from knack.io, which is a platform for human resources and screening candidates on the web. So that's what we have for next week. And unless
we have a
Tulio,
fourth.
if you have
We
the
have a
insight
fourth,
on the
Carlos.
Wednesday morning show.
Yes, we have a fourth that's
Yeah,
with
you
Swan
don't have.
Lee
Okay, cool.
at 10 a.m. Pacific. So we got 4 shows next week. Another full week.
Full house again. Full house again. Full week. Great. That's
Okay,
what we
well,
have right here on Dojo Live. At
thank you,
PM noon.
Carlos. Thank you, everyone, for joining us. Thanks for
Thank
being
you.
with us, Miguel. And we'll see you all back on Monday. Have a great weekend. Stay safe.
Thank you. Have a good one. Bye bye.